Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. Welcome, everybody. Joined today by Jamison. We're talking about why brokerage accounts are one of the most powerful tools in financial planning, but I think one of the most overlooked tools. So, Jamison, why do you think that is?
So they're definitely extremely flexible and liquid, and you can use them for opportunities, business investments, anything, any retirement accounts locked up. So I would say the ultimate control and flexibility and liquidity would be why.
Yeah, I think a lot of times like financial planning is sometimes like a workout or diet. Like you're gonna do kind of the bare minimum of what you're told to do. And I think in the financial planning, like if the obvious education out there is you max out a 401k, you max out a Roth IRA, you put money in 529 plans for your kids. And then people get to, where else should I save? And they go to a brokerage account, and then the common misconception is it's not tax efficient when it can be one of the most tax efficient things you do, but we'll get to that in a little bit. And there's no limit to how much you can put into it. So a lot of people, and even we've seen advisors will say, like, after you put in your 401k, Roth IRA, 529 plans, like start putting money in life insurance or other tax deferred vehicles. And this often gets overlooked, but a lot of times we find that life, is not necessarily on pause until 59 and a half when these other accounts become available. So having the liquidity is going to be super important in your 30s, 40s, and 50s when kids are going through school. Maybe you're doing renovations to your house. Maybe you were wanting to buy a second vacation house, and all these other type of accounts aren't available unless 529 plans are being used for college. With the 401k, you can take a loan up to $50,000 out, but you're going to miss market appreciation and pay interest. That could be probably the most expensive loan in history that you could do, other than like a credit card going really bad. So, with a brokerage account, there's a lot of ways to put tax efficiency into place, and there's a lot of flexibility with them. So before we go further though, Jamison, and high net worth clients that we work with, which I would define, let's just say 5 million plus. And then let's also talk about a second subset, 10 million plus. So in most of the clients that we work with 5 million plus, what percentage of their net worth do you think? Like, how is it broken down typically?
So when it's 5 million?
Yeah.
Probably, depends how long we've worked with them. So I would say normally there's a couple, how old are we talking?
Let's say 50s or 60s.
Okay, there's probably a couple million, 2 million in IRAs, 401ks. May or may not be Roth. Say they have $1 million Roth, and then the rest is brokerage, which would be what, 2 million? They probably have $1 million to 2 million in a brokerage account.
Yeah, and when we work below 5 million, I would say we'd see like a 70% qualified exposure. So in 401k, a 403b IRAs, probably 20% real estate exposure. So someone's worth $4 million, let's say. Typically they're going to have like $2.5 million in 401k IRA type environment. Maybe their house is worth $500,000 to $1 million. And then the rest would be kind of the liquid, but be a very small percentage of their net worth. Now, when you get to higher net worth, like 5 million, it becomes a bigger representation. But when you go over 10 million, I'm thinking of all the clients that we work with, the brokerage account represents the majority of their liquid net worth, because you're only throughout your lifetime. And typically these clients have either sold a business. They didn't like come into the wealth like slowly, like you would in a 401k. It was typically a big event. They sold a business, or they, were part of a business that they had equity in. Or they were extremely high income earner and they maxed out all these other avenues of like 401k. You can put the 415C limit at 70,000. You can do the backdoor Roth IRA. After that, if someone's, has a couple 100,000 of extra cash flow, there's no other place for that to go other than a brokerage account. So I would say if you plan on or already are a higher net worth person, a non-qualified type of investing is going to represent over 50% of your net worth easily. So how you do that becomes extremely important. So let's just break this down. Brokerage account, let's say, is worth 10 million bucks, and you walk in and you see a client has a mix of bonds and mutual funds. What would be immediate issues that you would bring up with that?
Well, he's probably working with an advisor. So the first step's fire your current advisor.
Why is that?
Let's start with the mutual funds. So mutual funds, number of reasons. What's the statistic? Like U.S. mutual funds, like 90% of fund managers underperform the corresponding index or some number like that.
Yeah, 1 year, like over half of them outperform the index. But then if you look over like 20-year periods, it's like less than 10%.
So mutual funds, just side note from whether in a brokerage account or not in the U.S. equities, high in fees, usually paying 100 basis points, close to maybe 80 basis points. They're underperforming the index, so that's bad. But then from when they're inside of a taxable account, mutual funds tend to have a lot of turnover, meaning the fund manager inside of that fund is going to sell stocks and buy and sell investments. And so those capital gains get pushed out to the mutual fund owners, even if you didn't sell it. So you could maintain that holding and let it ride, but the fund manager is making trades and kicking out taxes and capital gains to you every year. So it's unnecessary tax that can be avoided.
So let's just break that down. You have a $10 million mutual fund account, it's non-qualified. Typically, let's say there's turnover of 1.5%. In a mutual fund, because they're all mutual funds, totally normal, $150,000. You're the client, $150,000 of capital gains. You're in the top tax bracket. You have 30 grand, over 30 grand in taxes. You didn't even touch your money. So as this money is growing, it's like it's working for you, but it's also working for the government. Like you're writing this big check to the government.
And it's probably underperforming, and it's expensive.
And so that's one red flag you should never own mutual funds inside of a non-qualified environment in a brokerage account. Now, the other thing would be bonds. So you could hold municipal bonds and it'd be tax-free. If you're retired, this isn't good because the interest still qualifies as part of your MAGI, modified adjusted gross income. And so when you're qualifying like your Medicare calculations of how much you pay in Medicare premiums, when you're doing Roth conversion, what rate you're converting in, there's all these considerations that tax-free interest still goes into your tax calculations and does affect other things. So now with that being said, if someone held corporate bonds, let's say you had $10 million in corporate bonds paying 4% interest, what do the taxes look like on that?
Would you say 10 million?
Yeah, 10 million, 4%.
It's what, 400,000. You're paying your income tax rate that year.
It's 37 probably.
Yeah, states
plus 3% state in Pennsylvania. It's 40%. That's $160 a year you're covering in taxes. So all of this. So typically, these are some of the reasons why someone would avoid a brokerage account like a plague, is because you're paying tax along the way. Then you have to pay tax when you unwind it. So how you have to structure these very strategically. So I would say, first of all, what you hold in your brokerage account is of ultimate importance. So number one, ETFs are going to be much more efficient than mutual funds, specifically because of the turnover. So if you invest $1 million, it turns into $2 million. Generally speaking, in a mutual fund, you're going to be paying taxes along the way as it grows. If you're in an index, you're not going to pay taxes until it liquidates. Now, there's going to be some turnover because like companies do change. In the S&P 500, for example, but there's not going to be nearly as much turnover as there would be in a mutual fund. So ETF is by far a large improvement over a mutual fund. But even going farther than that, we would want to eliminate bonds. And so if you need to hold bonds or safe money, we would want to hold those inside of your 401k where that interest is growing tax-free. And then inside of a non-qualified account, we're big believers in something we offer is called direct indexing. So direct indexing, you're creating the index yourself with individual stock purchases. And so the benefit of that is you can completely control the turnover. So you're not going to pay tax unless you want to. But on the flip side of that, you in a good way, if a stock goes down, let's say Pepsi goes down, you sell it, you have a $100,000 position, it goes to 50, you sell it, you buy Coca-Cola. So your diversification and sector allocation is still the same or similar. that loss, as long as you don't go back to Pepsi in 30 days, that carries with you for the rest of your life. So that $50,000 now goes in a bank on your tax return. And any gain you have in the future in a passive environment, it could be a stock gain, it could be a real estate sale at a gain, it could be a business sale if you're structured, as an S corp, for example, at a gain. All of the dollar for dollar, that's going to offset the taxes you owe on any gain. So on $10 million account, we're able to get hundreds of thousands of dollars of those tax losses. So in the back end, when someone is selling the account, we've achieved the index returns, but while that's happening, we can get those tax loss harvests on the books to get ready for erasing a large part of the tax liability on the back end, all while staying within the tracking area that you would be in normally within an ETF, or close to. So anything to add on the direct indexing?
Yeah, I think you may have said this or not, but I don't know if you did. With an ETF or mutual fund, like we talked about, where the taxes are just pushed out to you, this gives you total control over. Obviously, some of the stocks may pay some dividends that you can't really avoid, but we're choosing when we buy or sell the stocks, and so you can avoid a lot of those unnecessary capital gains taxes being pushed out like an ETF or mutual fund.
Yeah, no question. The direct indexing, there's a lot of other things you can do from you could decide if you want to fund a donor advised fund, and you do that. So you can use 30% of your adjusted gross income. So if you're making $1 million a year and that's your adjusted gross income, you could take $300,000 of that, put it in a donor advised fund, get the deduction on that. But you could also fulfill that $300,000 contribution from an appreciated stock. So if you've invested in a stock worth, for 100, it's now worth 300, and you take that stock out of your direct index account and throw it in your donor advised fund, which then could pay your charity donations for the next 10 years if you're doing, whatever, 30 or 40,000 a year, because that donor advised fund's going to grow. We now got a 37% deduction on that 300, just like you would have if it was cash. Plus, we avoided that capital gain, that $200,000 gain, 23.8% federal capital gain rate. So now we just saved over 50% of the contribution. We saved 23.8% of the 200, plus we saved 37% of the 300. So we saved well over $150,000. So now for a lot of people that give charity that are using a standard deduction, they're not getting any tax benefits. But the direct index account, we can double dip. We can get the deduction and we can avoid the capital gains if we're able to take that sniper shot of an individual stock. If you have an ETF, it's all mixed together. We have to sell overall shares of the ETF or overall shares of the mutual fund. So it provides a lot of flexibility. And typically higher net worth clients are going to want to be extremely tax efficient and have that flexibility and control. So the direct indexing is not just a tax savings along the way. It's a tax savings in the future, but it also enhances other endeavors you could do like charities along the way as well. So, let's talk about, I think it's common for people to think, I'm going to get a financial plan, it's going to go on autopilot. Well, the reality is life happens, and every year things change. Life evolves. Life has ebb and flows. And so a lot of the times in a financial plan, you're going to need money unexpectedly. And this happens every year for most of our clients. Stuff comes up. So a lot of people think, well, shouldn't I have cash for that? And we've seen, clients before they become our clients sometimes carry an astronomical large cash on their balance sheet. So one of the strategies we've secured around the brokerage accounts that enables clients to really put that cash to work, but also maintain the liquidity, is called a secured line of credit. So James, let's break down the benefits of someone carrying cash, not investing, wondering if they're going to need it, versus investing their whole life in a brokerage account and then temporarily making, withdrawals and putbacks along the way. Break down the math for us.
Yeah. So, if you keep it in cash, obviously the last couple of years, you've gotten probably 4 to 5% in interest. That's not gonna happen long term. That interest is also taxed each year. Your income rate, if you're a high income earner, it's 37%. So what's the net? I don't know. You're probably getting 2.5% interest on that cash after taxes. And you may or may not use it. A lot of times people hold it for longer than they need to. And so if we invest it and open a line of credit, let's say you have $5 million in an investment account, you can get a secured line of credit, same thing as a home equity line of credit, but your investment account is the collateral, and they may give you $2.5 million available in a line of credit. There's no cost to have it open. You only pay interest if you draw on it. So if you draw $1 million on it to do a house project or whatever you need it for, all of that money stays invested in the direct indexing. So opposite of like a 401k loan where the money comes out of the market. So it stays invested. Ideally you're getting whatever the annual rate of return is on it. The money's growing, and then you just pay interest on the money that you take out. So this makes a lot of sense if you're a high income earner, and instead of keeping it in cash, and you can pay this off in 3 to 6 months, for example, the interest would be a few $1,000s, very minimal. And it's in that scenario, it could be worth it to keep the money invested and let it grow in the market. Where it's not going to make sense is if you don't want to do this for like a long-term, 5-year, 7-year loan, because interest rate's higher than you would get on just like a fixed loan.
No question. Yeah. And I think, just like super high level cash, it is what it is. You keep it there. You're paying interest on that, whatever. If it's 2%, that interest you're paying taxes on. So really, if you're a high income earner, it's almost the returns are getting cut in half. But if you're in this direct index account with a secured line of credit against, first of all, the secured line of credit is not going to cost you anything if you never use it. There's no interest. There's no setup fee. We use Goldman Sachs as the main provider for that. But I have one myself, and the reason I love it is it's like, it feels like I still have the cash, but all the time, 99.9% of the time I don't need the cash. It's earning the market returns because it's allowing my money to be in the market. But I still, if an emergency happens, I can pull from it and put it back in as needed. So I still carry an emergency fund of 6 months, but above that, that's why everything with me goes in the market. But the other major benefit of that is, if you don't have this and you're like, oh no, I need money, you pull out of your investments and you're going to pay capital gain taxes. Or if you're direct index, you're going to use some of your tax loss harvests to offset those capital gains. But if this is a short-term thing, if you have an emergency, you're putting it, like you said, a couple months, you're taking it out, putting it back in. Wouldn't it be nice to not have to pay those capital gains? And that's what a secure line of credit does. If you have $10 million in here and suddenly you need $1 million for something, you can let your 10 million go untouched. You take the $1 million from the secure line of credit. A couple months later, you pop it back in. Your portfolio goes untouched. So it doesn't matter if the market was down during that period. Like if, the 15% drop we just occurred, if you needed money during the bottom of that, you could have avoided a costly mistake in pulling when the market's low by having the secure line of credit. So we're avoiding taxes and market timing, which allows you to really follow the number one principles of financial planning, invest with the market long term. It's time in the market. It's not timing the market, it's time in the market that matters. So, okay. So let's talk about, we've talked about obviously the flexibility, these accounts you can pull from anytime for any reason, just like cash in a bank. Let's talk about for business owners. Let's first talk about estate planning, and then let's talk about some of the benefits also for business owners. So estate planning. Currently, the law exists that gives this an extra benefit of this is money that you want to pass on. So James, can you break down, like if you're passing money on to kids, you have a Roth IRA, a traditional IRA, and a brokerage account. Let's walk through how those each look, assuming you're under the exemption. So you're under that $14 million exemption approximately. And so we don't have federal estate tax. We're just talking about investment tax or, income taxes on the money. How would that work? So let's just use the example, like $1 million in a Roth, $1 million in a traditional IRA, and $1 million in a brokerage account and let's say the brokerage account has $500,000 of basis, $500,000 of gains.
The Roth IRA passes, everything is going to hit state inheritance tax depending on the state. So Pennsylvania. Everything.
And some states don't have it, but Pennsylvania is 4.5%.
Everything except life insurance. So, that you can't really avoid. The Roth IRA would go tax-free outside of that inheritance tax, to the state inheritance tax. The beneficiaries have 10 years to pull it out. So they could take it a little bit every year. They could take it one year, all of it. They don't pay any taxes on it because it's Roth. It just has to come out in 10 years. The traditional IRA passes to them, also have 10 years to take it out. They're going to pay their income tax rate on it when they take the distributions. So depends what income tax rate the beneficiary's in, what the best strategy is to pull that out. But they're paying tax on it. The taxable account, let's say, would you say there's $1 million?
Yeah, $500,000 a basis, $500,000 a gain.
Yeah, so that under current law receives what's called a step up in basis. So if there's a $500,000 basis, $1 million account, if the parent were to sell that the day before they die, they pay capital gains taxes on that. If they didn't, and that goes to the kid, the basis gets stepped up. So now instead of the basis being $500,000, the basis is $1 million. And so they theoretically could sell it all and not pay any taxes or let it ride. And now all the growth is based on that $1 million basis. So it can be a good estate planning tool. You get that step up in basis and kids can avoid some of the tax.
Yeah, that's a great breakdown. So I would say one of the last benefits then would be if you're a business owner. You've seen a lot of business owners, recently are dealing with a lot of decision fatigue, a lot of burnout, post-COVID, running a company. And a lot of times, if industries change and the business owner, has most of their net worth in the business, which is typically the case, if something happens, depending on the marketplace, it'd be hard to get a loan or the business owner may not take a loan. So having a brokerage account, you can, if you're a S Corp or an LLC or whatever you are, you can always loan yourself money through your business. And the easiest way to do that would be if you have a brokerage account, taking that line of credit and then putting it in and putting it back out. So I think as a business owner, it's really healthy to stack chips outside. It may not be the best return that you can get, but it's going to prevent you from having to take unnecessary capital in inopportune times to keep your business running, which is inevitably going to have ebbs and flows. That's personally something I'm always, focused on, for our company is making sure that there's always capital. So, we're never in a bad position if market drops or, things ebb and flow, conditions change. We don't have to take on the wrong partner, for some reason. So one of the best things I think as a business owner you can do is really try to stack your brokerage account because it's a way to insulate, put a kind of a moat around your castle of your business. Anything to add there? I know you work with a lot of business owners and I'm sure have that perspective as well.
No, just creates some flexibility and peace of mind that you have some money growing that's available that's outside of the business.
No question. Well, I think that's it. Yeah. So as the other thing I would say is if you're later in life and your tax brackets have dropped, you probably want to strongly consider some Roth conversions. And when doing a Roth conversion, if you're over 59 and a half, like you could take 100,000 from a traditional IRA, convert to Roth, you could pay the taxes out of that, but it's always best to pay the taxes out of a different source. And so if you have a brokerage account, that allows all 100 to stay in the Roth and you pay the taxes out of pocket. So clients that have brokerage accounts, we see their retirement plans work a lot better. You may fill, traditional IRA, Social Security, and a pension payment. You may be taking out required minimum distributions out of your IRA and kind of filling those low brackets, the 10, the 12, the 22, and the 24. Well, let's say you need more money. If you have a brokerage account, then instead of going to a 32% bracket, like most people would if they had all their money stuck in a 401k, you can stay at that. You can actually drop and go to a 15% capital gain bracket, start withdrawing from your brokerage account, or go to zero if you have a Roth account and go over. So it gives you complete flexibility. Brokerage accounts and Roth exposure give you complete flexibility in navigating tax brackets, keeping those low. You control what bracket you're in versus the government controlling what bracket you're in when you retire. So this is not only a flexibility thing, it greatly enhances your distribution planning later in life. Another thing I would say too is it is one of the best retirement planning tools. So we talked about pre-retirement, but post-retirement, a lot of people want to be financially independent, maybe take a sabbatical in their 40s or 50s, take a year or two off. If all your money is just stuck in a 401k, you don't have that flexibility. A brokerage account gives you flexibility to retire early, become financially independent, take mini retirements along the way. It gives you all the flexibility. That's why I value it as the number one tool in financial planning for high net worth or high income earners. You got to still do all the easy stuff first. Max out your Roth 401k, backdoor Roth, HSA. Got to fund the 529 plans if you have kids. Make sure your risk management plan's in place with your insurance. After that, you should be really stacking a brokerage account. And now with direct indexing in play, that it's not tax efficient is crazy. I think it's literally one of the most tax efficient and flexible things you can do if you're with the right partner that's able to direct index and mitigate the taxes. So thanks for joining, everybody, and look forward to catching everybody next week. Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.